When choosing an appropriate business entity, it's important to consider numerous factors, such as ease of formation, federal and state income tax laws, management rights and control, liability for losses, transferability of ownership shares, and continuity. First, we'll discuss a sole proprietorship. A sole proprietorship is an unincorporated business owned by a single person. This business entity form usually does not require governmental filing or any other documentation other than sometimes a business name statement, which provides the owner's name and address and the name under which the owner will conduct the business. This is sometimes known as a DBA for doing business as. The main advantages of this business entity form include the owner's absolute control in terms of management rights and avoidance of double taxation, as sole proprietorships are not separate legal entities. The sole proprietor reports the business's expenses and income on his or her own personal income tax return. The main disadvantage of a sole proprietorship is the owner's unlimited personal liability for losses of the business. The sole proprietor can freely transfer interests in the business, but the death of a sole proprietor will dissolve the proprietorship. Notably, sole proprietorships can also be a default entity because if a single person conducts a business without filing with the state to form such other entity, like an LLC or a corporation, the business will, by default, be considered a sole proprietorship. Next, we'll turn to partnerships. There are various kinds of business partnerships, including general partnerships, limited liability partnerships, and limited liability limited partnerships. Partnership law originated in the common law, however, it is now codified in the Uniform Partnership Act and the Revised Uniform Partnership Act. These uniform acts are written by experts in the area and are only binding where they are adopted by states. In the case of the Uniform Partnership Act and many similar acts, these essentially are binding across the country. Let's first discuss the general partnership. A general partnership is an unincorporated business association that does not require any filings with the state. A general partnership is formed whenever two or more people co-own a business for profit. As such, general partnership can be created by default, even if there are no filings or even any intentions to form a business organization among the partners. The main characteristics of general partnerships are, first, each partner has unlimited liability with respect to the partnership and the partnership debts. Second, each partner has equal rights to management and control. Third, the individual partners are taxed for the partnership income. The partnership by default is not a separate taxable entity, though in some cases tax filings can be made to elect otherwise. Fourth, the financial interest of each partner is freely transferable, but all partners need to agree in order to transfer membership in the partnership. And lastly, general partnerships have advantages in terms of continuity, since death, bankruptcy, or withdrawal of a partner usually does not dissolve a general partnership under the Revised Uniform Partnership Act. Next, let's look at the limited partnership. A limited partnership is an unincorporated business association that requires filing of a certificate of limited partnership with the state. Each limited partnership must have at least one general partner and at least one limited partner. The main characteristics of the limited partnership are general partners have unlimited liability for partnership debts, while limited partners have limited liability. General partners have equal management and control rights, while limited partners have no management and control rights. A limited partnership may also elect to not be treated as a separate taxable entity in order to avoid double taxation, except for publicly traded limited partnerships, which are subject to corporate income taxation. Partners may assign their financial interests in the partnership, but the assignee can only become a limited partner if all partners consent. And lastly, only death, bankruptcy, or withdrawal of a general partner will dissolve a limited partnership. The LLP, or Limited Liability Partnership, is also an unincorporated business association that requires filing with the state. Limited liability partnerships are similar to general partnerships, except that they enable partners to limit their liability for the misconduct of other partners. But each partner has unlimited liability for his or her own misconduct. The LLP is typically used by professional partnerships, such as law firms or accounting firms, because state laws very often restrict professional partnerships from organizing as regular limited partnerships. So instead, they form LLPs. Apart from specific filing requirements and the ability to limit liability, limited liability partnerships are very similar to general partnerships. Next, we have a similar form of business called the LLLP, or Limited Liability Limited Partnership. An LLLP is also an unincorporated business association that requires filing with the state. A limited liability limited partnership is essentially a limited partnership that enables even the general partners to limit their liability, just like an LLP. In all other ways, they're very similar to limited partnerships. Next, we have the LLC, or Limited Liability Company. An LLC is also an unincorporated business association that requires a filing with the state. An LLC combines the benefit of partnership laws with the benefit of corporation laws. In an LLC, all of its members have limited liability, but each member can participate in management decisions, which makes LLCs very attractive. On top of that, a properly structured LLC has taxation benefits. Generally speaking, only the members are taxed, as the LLC can elect not to be considered a separate taxable entity. If the LLC has only one member, it can be taxed as a sole proprietorship, unless that member elects to have the LLC taxed as a corporation, which is rare but can sometimes be useful. Typically, members can assign their financial interests in an LLC, but the assignee can become a member only if the other members consent, or if the LLC's operating agreements provide otherwise. It varies from state to state whether death, bankruptcy, or withdrawal of a member necessarily dissolves the LLC, and state default rules can often be modified by an LLC operating agreement. Next, we'll move to corporations. A corporation is a business entity whose existence is distinct from those that own it and/or manage it. The main characteristics of a corporation are: 1. It can be formed only by filing with the state, and filings must substantially comply with state incorporation statutes. 2. It is a separate legal entity from its owners and/or managers, and as such, it can independently sue, be sued, contract, and hold title to corporate property. 3. Its management is heavily centralized, and those in management don't even necessarily have to be shareholders of the corporation. 4. Shareholders generally have limited liability for the corporation's debts and legal obligations. 5. Unless otherwise specified in the Articles of Incorporation, a corporation has perpetual existence, so death or withdrawal of a shareholder or a manager will not terminate the existence of the corporation. 6. Ownership of corporate shares is easily transferable. 7. A corporation can be considered a person or citizen. Such classification is important for corporations because personhood entitles corporations to many important protections provided in the Constitution of the United States, while citizenship is important for jurisdictional issues in litigation. And 8, since a corporation is a separate legal entity, it is subject to double taxation, unless it elects to be treated as an S corporation, which is so called because it's taxed under subchapter S of the Internal Revenue Code. Under the double taxation principle, based on subchapter C of the Internal Revenue Code for a C corporation, the income of the corporation itself is directly taxed, and corporate profits are taxed separately a second time when they go to the hands of the corporation's owners or shareholders once they're distributed. Generally speaking, they are distributed as dividends. Next, let's move to the S corporation. In order to become an S corporation, a corporation must submit specific forms to the Internal Revenue Service signed by the shareholders. This form is called a Form 2553, election by a small business corporation. Becoming an S corporation allows corporations to avoid double taxation on the corporate income by passing corporate income to their shareholders for federal tax purposes. It also enables a corporation to pass losses, deductions, and credits to their shareholders. In essence, becoming an S corporation enables the corporation to be taxed as a partnership. The corporation must meet the following requirements in order to qualify for S corporation status. 1. It must be a domestic corporation. 2. It must have only allowable shareholders, who may be individuals, certain trusts, and estates, but may not be partnerships, other corporations, or non-resident alien shareholders. 3. It cannot have more than 100 shareholders. 4. It must have only one class of stock. And 5. It must not fall into an ineligible corporation category, such as certain financial institutions, insurance companies, and domestic international sales corporations.